American e-commerce is facing huge turbulence as Temu has emerged as a formidable challenger, reshaping the landscape at an unbelievable pace. In just 1 year, Temu has amassed 51 million monthly active users in the US, rapidly closing in on Amazon's 67 million user base that took decades for Amazon to develop. But how has Temu achieved this explosive growth? Let's find out. In the last decade, several Chinese e-commerce companies like TikTok, Shein, and AliExpress have entered the US market. Yet none have soared to the heights that Temu has achieved in just 1 year. Central to Temu's rapid success is its business model as a discount retailer. Unlike traditional US retailers, Temu offers products directly from Chinese manufacturers and wholesalers, allowing it to slash prices dramatically. This direct-to-consumer approach not only cuts overhead costs, but also passes significant savings onto the shoppers. Imagine snagging a stylish jacket for just $20 or a durable stainless steel water bottle for merely $9, prices that are hard to match by conventional retailers. However, competitive pricing is only part of the equation. The true catalyst for Temu's explosive growth is its aggressive and innovative marketing strategies. When Temu first launched, it did quietly, but it wasn't long before it bombarded the internet with aggressive advertisements. In 2023 alone, Temu invested a staggering $1.3 billion in marketing efforts, a figure that is projected to more than double to $3 billion in 2024, thanks to the deep pockets of its parent company, Pinduoduo. This massive investment highlights Temu's commitment to capturing and expanding its market share. But how is Temu converting its hefty advertising spend into a loyal customer base? The answer again lies in their clever marketing tactics. Temu entices new users with a spinning roulette wheel, gifting a $200 sign-up bonus. This not only creates an immediate incentive to start shopping, but also gamifies the overall shopping experience. And as users browse the app, they encounter timers counting down on sales or displaying an almost sold-out status, which compels them to make quick decisions and purchases. This strategy doesn't just draw users in, it converts them into repeat customers, creating a robust cycle of consumer engagement and retention. These marketing tactics have been working extremely well for Temu. Within just 6 months, it attracted more users than Shein has in 8 years. In 2023, Temu achieved an impressive $17 billion in sales, and PDD, its parent company, saw a 74% increase in market value, briefly overtaking Alibaba as China's most valuable e-commerce company. This clever approach, combining cost-effective pricing with aggressive marketing and psychological incentives, has not only broadened Temu's appeal, but also ensured its place as a disruptive force in American e-commerce. Temu's aggressive pricing strategy could pressure American retailers to lower their prices, potentially leading to a race to the bottom that could severely impact the retail sector, affecting everything from employment in retail to the overall quality of products and services. This impact is already evident as Amazon has started incentivizing its sellers by reducing its fees charged in various categories. Temu's rapid growth and massive marketing spendings are pressuring other e-commerce giants to allocate more resources toward advertising and customer acquisition. This shift could result in inflated costs of reaching consumers, pushing advertising expenses to sky-high levels. Despite criticisms of low-quality products, often described as cheap Chinese imports that do not meet durability standards or match product descriptions, Temu continues its aggressive market expansion, potentially lowering overall market standards. The reliance on marketing could overshadow the importance of product and service quality, which is a concerning potential outcome. Still, the long-term effect on American e-commerce is subject to the sustainability of Temu as a business model. Despite Temu's impressive growth, it seems the company is faced with an unsustainable business model. While Amazon has invested decades in building its delivery network in the US, reducing its average delivery time to 2 days, other e-commerce giants like eBay and Walmart have managed to reduce their average delivery time to around 4.5 days. However, Temu's reliance on overseas shipping extends delivery times to an average of 11 days, more than 5 times longer than Amazon. This discrepancy in speeds presents a significant challenge for Temu. especially in an era where consumers expect more instant gratification. For now, Temu seems to be successfully managing the trade-off between low prices and delivery efficiency. The real challenge in Temu's logistical complexity, however, is not the shipping time, but the unsustainable shipping costs that Temu is bearing. Consider this basic $8 bag, where the shipping cost from China to the US is $3 to $4, about half the price of the bag itself. With such substantial shipping expenditures, it's nearly impossible for the online retailer to sustain its business without raising prices. Temu is planning to shift its warehouses to the US in 2024 to tackle this shipping problem, but setting up and maintaining warehouses in the US will inevitably increase operational costs and could severely impact its low-price business model. In 2023, it was estimated that Temu was losing $7 per order, and at that rate, maintaining or scaling its business model without compromising its pricing strategy would be challenging. But the rise of Temu is not without controversy. The company has been under scrutiny, especially after its parent company had its app removed from the Google Play Store in 2023 and was accused of allegations of privacy violations and the presence of malware within its app. This event has sparked a lot of debate about the real nature of Temu's business operations. While operating as a discount e-commerce platform, Temu is accused of being extensively involved in data harvesting and monetization. This suspicion is reinforced by the company's ability to offer products at exceptionally low prices, leading some analysts to believe that these prices could be subsidized by the sale of consumer data. The ethical implications of such a strategy are substantial, raising significant concerns about consumer privacy and the transparency of Temu's operations. If it is true that Temu is leveraging extensive data collection to subsidize its income and capture market share, this could fundamentally alter the perception of its business integrity and ethical standing. However, it's essential to note that these practices are ubiquitous across all digital sectors. Major companies like Amazon, TikTok, Uber, and Lyft have used similar approaches to consolidate market share and enhance their service offerings. Amazon, for instance, has famously leveraged data from its vast customer base to refine its marketing strategies and product recommendations, often operating on thin profit margins. Therefore, while the allegations against Temu warrant scrutiny, they also reflect a widespread and increasingly accepted business strategy in the digital age. By slashing prices and streamlining the path from manufacturer to consumer, Temu has not only challenged traditional retail models, but also raised significant concerns about sustainability and data privacy. As the landscape continues to evolve, these issues will dictate the long-term viability of such disruptive business strategies. Before we wrap up this video, we'd like to hear from you. What are your thoughts on Temu's impact on American e-commerce? Do you see their business model as a blueprint for future enterprises or as a cautionary tale? Thanks for watching our video. If you've enjoyed it, show your support by liking it and subscribing to our channel.